I watched Marcus lose $47,000 in 3 weeks. Not to a scam, not to a Ponzi scheme, but to 5 trading psychology mistakes 95% of beginner traders and some so-called experienced traders make in their first few years of trading. Marcus was a beginner trader, and 3 weeks before losing everything, he texted me a screenshot of his account, and he was up $12,000. And just like you and I when we're up, he thought he'd cracked the code. So how did he go from being $12,000 up to losing $47,000 in just 3 weeks? You might think Marcus was unlucky, but luck has nothing to do with it. As a matter of fact, he was predictable. I have seen the pattern of mistakes over and over again with countless traders and knew that it's only a matter of time before he lost it all. Every single beginner and some experienced traders makes these exact same 5 mistakes. And right now, as you're watching this, you're probably making at least 3 of them in your trading. By the end of this video, you will know exactly what Marcus did wrong, why 95% of traders fail in their first few years, and more importantly, how to be part of the 5% who don't. Mistake number 1. Calendar bias. The days you don't trade matter. Nobody talks about this silent killer, but calendar bias destroyed Marcus faster than any leverage mistake or emotional meltdown ever could. After grinding through 2 brutal months of Forex trading, Marcus finally thought he had cracked the code of the perfect trading day. Staring at his trading journal one late night, he noticed something that made his heart race with excitement. He was crushing it on Tuesdays and Wednesdays. His Euro-USD scalps on Tuesdays averaged 23 pips profit, and his Wednesday trades were pure gold, with about 78% win rate. His brain did what human brains are evolutionarily wired to do. It spotted a pattern and clamped onto it like a vice grip, while completely ignoring the randomness lurking beneath. So Marcus started playing favorites with the calendar. On his golden days, he would triple his position sizes, sometimes risk 6% per trade instead of his usual 1%. He would wake up Tuesday mornings like a kid on Christmas, ready to capitalize on his statistical edge. Meanwhile, Mondays, Thursdays, and Fridays became ghost towns in his trading account. The probabilities just aren't there, he would rationalize, feeling like a data-driven genius while sipping his morning coffee. But the brutal reality that annihilated his account was that the markets couldn't care less about your calendar superstitions. That beautiful pattern Marcus discovered was nothing more than random market noise masquerading as meaningful data over his laughably small sample size of 60 trading days. But because he was betting the farm on his lucky days, when Tuesday and Wednesday inevitably turned into bloodbaths, and they always do, the losses were absolutely devastating. And the cruelest twist of the knife, Marcus missed the trade of a lifetime on a Thursday afternoon when the dollar-yen pair broke through major resistance and ran 240 pips in 18 hours after a surprise Bank of Japan intervention. He watched it unfold in real time, paralyzed, because Thursday wasn't one of his statistically superior days. At a point in my trading career, I also noticed Tuesdays to Thursdays were kinda pretty cool trading days too. But what I've come to realize is that this type of thinking is exactly what leads traders down the rabbit hole of calendar superstition. It feels so logical, so data-driven. And when you bet big on days like that, it's actually the beginning of the end for most accounts. Calendar bias is a dangerous trap. It makes you ramp up risk during perceived favorable conditions, while forcing you to sit on the sidelines during perceived unfavorable ones. It's backwards thinking that feels logical in the moment, but it's really just superstition dressed up as strategy. Mistake number 2. The winner's curse. Taking profits too early on your best trades. Marcus had a golden rule that sounded absolutely bulletproof. Take 30 pips and you will never blow your account. His trading mentor, a guy who claimed to have made millions trading the London session, had drilled this into his head like gospel. It felt safe, conservative, and mathematically sound. Marcus would catch Euro USD breaking through resistance at 1.085, ride it up to 1.088, and immediately slam the close button. Bank those 30 pips, he would tell himself, watching his account tick up $300 on his standard lot position. The dopamine hit was intoxicating, quick, clean, and profitable. But then, he would sit there helplessly as that same Euro USD breakout absolutely exploded higher, ripping through 1.092, 1.095, and eventually topping out at 1.108 3 days later. While Marcus was celebrating his disciplined $300 win, he had just missed out on a potential $2,300 monster trade. The same pattern played out over and over. Moves that should have been 150 pip winners got chopped down to 30 pip scraps. This psychological torture was slowly bleeding him dry in the most insidious way possible. Marcus was taking a machete to every potential home run, while letting every strikeout drag on until it destroyed his account. His average winning trade was a measly 30 pips, worth about $280 after commission, while his average losing trade was a devastating 95 pips, costing him $950 each time. Even with an impressive 64% win rate, he was hemorrhaging money every single month like a patient with internal bleeding. The math is absolutely savage. If you're making $280 on winners, but losing $950 on losers, you need to be right 77% of the time just to break even. Marcus had unknowingly rigged the game against himself, creating an impossible standard that even the world's best traders couldn't maintain. See, our primitive brains are hardwired to avoid the regret of watching paper profits evaporate. We would rather lock in a guaranteed small win than risk seeing those beautiful green numbers turn red. But elite traders flip this psychology completely upside down. They let their winners run like wild horses while choking their losers before they can inflict real damage. Mistake number 3. The correlation trap, thinking you're diversified when you're not. Marcus stared at his trading screen on that fateful Wednesday morning, watching his carefully constructed portfolio bleed red across every position. The irony wasn't lost on him. Had spent months lecturing his friends about the importance of diversification, proudly showing off his sophisticated 5-stock strategy. "I'm not like those amateur traders who put everything into one stock," he'd boast. "I spread my risk across multiple companies. That's how the pros do it." His portfolio looked impressive on paper. Apple, the tech giant that never disappoints. Microsoft, cloud computing powerhouse. Google, search and advertising dominance. Amazon, e-commerce leader. And Netflix, streaming entertainment king. 5 different companies, 5 different business models, diversification at its finest, or so he thought. When Jerome Powell stepped up to the microphone one Tuesday afternoon and announced the Federal Reserve's most aggressive interest rate hike in decades, Marcus felt confident. "Sure, some stocks might dip," he reasoned, "but I am protected. My positions are spread out." The next morning's market open was a bloodbath. Apple, down 8%. Microsoft was down 11%. Google, negative 9%. Amazon and Netflix down 12% and 15% respectively. Total damage in cash was $7,350 in a single session. Marcus watched his screen in horror as each position moved in perfect, devastating synchronization. Every stock he owned was falling at nearly the same rate, at the same time, and for the same reason. His diversified portfolio was behaving like one massive, concentrated bet. The painful truth hit him like a freight train. He thought he had diversification, but he actually had concentration disguised as diversification. While you might argue that this is the business of those who are in stock trading or investments, the truth is, this trap is everywhere. Crypto traders who think they are diversified because they hold Bitcoin, Ethereum, Solana, and Cardano, but when Bitcoin crashes, everything follows. Options traders who sell puts on Tesla, Ford, and GM, thinking they're spread out. But when car sales tank, all three get destroyed. True diversification requires investing across asset classes that react differently to market conditions, not just different stocks in the same sector. A properly diversified portfolio should include varied equity exposures, large and small cap, domestic and international, fixed income with different risk profiles, and alternative assets like real estate and commodities to balance risk and returns. Mistake number 4. Position size creep. The slow death by success. This mistake is absolutely brutal because it feels like you're doing everything right. Marcus started with perfect discipline, 1% per trade, no exceptions. And for 3 months, he stuck to this religiously. But then the wind started coming. And this is where human psychology becomes lethal. Success is intoxicating, and with each profitable trade, Marcus felt the rush of validation. I'm finally cracking the code, he thought. The market seemed to whisper his name. His confidence didn't just grow, it metastasized. 1% became 2%. I'm on a hot streak, then 3%. I understand this market better than ever, then 5%. Why leave money on the table when I know I'm right? Each increase felt logical, inevitable even. Marcus wasn't gambling, he was evolving as a trader, and by month 5, Marcus was risking $2,500 per trade, way more than triple his original size. The terrifying part is that he didn't even realize he had crossed the line from discipline to destruction. And if you are wondering how it ended, here is the math that killed him. When Marcus started, a 10% account drawdown meant losing $500. Painful, but survivable. A scratch on the armor. By month 5, that same 10% drawdown meant losing $5,000. 3 consecutive losses would obliterate 2 months of gains in a matter of days. Then came the brutal week. 3 losers in a row, 5 days, and $7,400 gone, more than he had made in his first 4 months combined. Position size creep is the silent account assassin. It masquerades as growth, whispering that you are becoming a better trader when you are actually just becoming a bigger gambler. More risk isn't more skill, it's just more risk. Mistake number 5. The progress trap, measuring the wrong metrics. This is the most insidious mistake because it makes you feel successful while you're actually failing. Marcus tracked everything obsessively. Win rate, number of green days, biggest single-day gains, monthly profit streaks. He was celebrating hitting 70% winners for the week, screenshot his best days, and share on his WhatsApp story. He felt like he was improving because all his metrics were trending upward. But Marcus never tracked the one metric that actually matters: risk-adjusted returns. He never calculated whether his gains were proportional to the risks he was taking. Marcus would make $300 on a trade where he risked $2,000, then celebrate the win and add it to his successful trades list. That's a 15% return on the money he put at risk, which is terrible by any professional standard. Meanwhile, when Marcus lost, he would lose the full $2,000. So he was making $300 when right and losing $2,000 when wrong. Even with a 65% win rate, the math was destroying him slowly, methodically, while he celebrated his high success rate. If you are wondering what happened to Marcus after losing that $47,000, his summer job money, his internship savings, even some cash he had borrowed from his parents, Marcus didn't quit. He spent 3 months studying his trade logs, not just what he bought and sold, but when, why, and how much. And that's when he discovered every single hidden mistake I just shared with you. But there's a twist. About 13 months later, Marcus texted me again. This time, it wasn't a screenshot of losses. It was a photo of a notebook filled with trading rules, position sizes, and a detailed plan for every single trade. He had started over with just $2,000, but this time he was following every principle that could have saved his original account. Last month, he sent me another message. His account hit $15,000, not from one lucky trade, not from following hot tips or finding the next GameStop, but from boring, consistent, disciplined trading that avoided every psychological trap that had destroyed him before. The difference between the 97% who fail and the 3% who succeed isn't intelligence, it isn't luck, it isn't having inside information. It's simply this: the winners make their mistakes small and their wins big, and the losers do the opposite. Marcus learned this lesson the hard way by losing everything first, just like I did, but you don't have to. My hope is this video will save you from making these 5 mistakes, which could be worth tens of thousands of dollars to your future self. But the real question is, are you going to be like first-year Marcus or comeback Marcus? The choice is yours, but choose wisely, because the market will teach you these lessons one way or another. The question is, do you want to pay $47,000 for the education? If you found value in this video, please hit the like button and share it. This helps us reach other traders who need to see this message. And if you're not already subscribed, do it now. Your future trading account will thank you. Another problem you will likely face is fear in trading, a silent thief that steals opportunities and stunts growth. Left unchecked, fear breeds hesitation and creates a pattern of avoiding challenges that extends beyond trading into every area of life. In this recommended video, I explore how to overcome fear, reclaim control, and turn calculated risks into rewards. Until next time, may the trend be with you.